slight bias when I talk about the Swiss framework, and you know, I'm transparent about that coming from there. But what I would like to present to you now is what really is it that put Switzerland on the map in the blockchain and the crypto context. And it had a very prominent role in the initial years and still continues to do that. And I personally think that there's a couple of reasons for that. First of all, Switzerland has the benefit of, in general, a principles-based regulation. Right? It's not a super detailed sector regulation like in other territories, and I'm not judging whether it is a good or bad thing, but it allows then for the regulator, and I should note that FINMA, our regulator, the Financial Market Authority of Switzerland, is not a light touch regulator, but is a tough regulator. And that's a good thing because the regulator is the business card of a country. It is what creates the credibility and acceptance of the country. Could then look at things on a case-by-case basis as they found their way to their doorstep. And that was very, very important because, you know, there was things that had never been seen before, and everything was different, right? And so based on this principles-based regulation and an open mindset, for which we have to be grateful, FINMA was open to discussion and look at things on a case-by-case basis. They came to conclusions, and they were offering guidance, and they were offering some kind of predictability and reliability by offering the opportunity to provide positive or negative rulings around situations, saying whether something falls into the financial markets regulation or not, or whether it's outside and hence free to operate, etc. I think that was one of the key elements. Other elements were obviously the availability of an ecosystem, which means that you also need other elements to be in place, such as simple things like location, funding, talent, access to institutions of higher education and research, where obviously, again, the talent was shaped that then helped with the unfolding of that market. Also, it was an open market, and a lot of the talent that created the so-called crypto valley or the blockchain nation of Switzerland came to Switzerland because they were attracted by this, you know, supportive environment. If I want to go off a little bit in La La Land maybe, but I also believe what allowed Switzerland to embrace that a little bit more is that, as I sometimes say, we have decentralization and consensus building in our DNA. It's probably one of the most elaborate direct democracies. So people are used to, you know, decentralized decision taking. And also the consensus building when you have to vote on everything. That's kind of something we understand, which maybe made it a little easier on a, you know, national level even to embrace that and support that than other locations which have a bit of a more centralistic and deterministic tradition and history. Just a little bit of background. The one thing I really want to focus on in my presentation about Switzerland is the Swiss token classification. Because that was something that you can see kind of as a key inspiration point for many of the rules that have been created all around the world since. And I believe it's important to understand the main thinking behind it. But maybe let's start with a little bit of a roadmap again. Sorry about it, typical lawyers slide, very busy as it is. And again, I don't expect you to get excited about the nitty-gritty details, which is really just for people kind of with my kind of mindset and preferences. But there's some interesting elements in there which might be useful for other locations embarking on that journey. So as I said, we didn't have a existing set of rules. We were using principles and applying them in Switzerland, but based on initial things that happened in Switzerland, you know, the launch of Ethereum, etc., Tezos, and so forth, led FINMA to rather early in the game, back in 2017, to release a report, the first report to undertake investigations and then report on that by way of a guidance, which was guidance 04/2017. Which talked about the regulatory treatment of initial coin offerings, ICOs, and pointing out some key elements therein, which I will get to in a moment. A little later, at the beginning of 2018, in February, FINMA then issued its ICO guidelines, which were really key for a lot of the work that was undertaken, because this was then used as the basis to approach FINMA and to obtain the rulings, which I've been alluding to previously. Also on the tax level, obviously, it was and is possible in Switzerland to obtain tax rulings about classifications and treatment of those exciting new things, which again adds to the predictability and reliability of your endeavor, which then is again a better basis to put funds behind it. FINMA then did something that was not common before that. They did roundtables, and I had obviously the privilege to attend one of them, and they really had to move to bigger locations in Zug and other places, because people not only from Switzerland and from the Crypto Valley, but from all over the world started flocking in, listening to our regulators and their views and the guidance they were providing. And it sometimes almost felt like regulators turned into rock stars. But I can only compliment them on the work they've done. I think it was the right way of doing it, and it was very helpful for the entire process. So then further guidelines were provided, and then also the other standard setters in Bern, in particular towards creating a legal basis in the shape of a law, started to kick in there, and I will get into this in a moment. So the latest development is now that, since we still don't have one law, one act governing all of that, first efforts in this direction have started and have taken shape, and the consultation on such a framework for blockchain DLT is now on the table and is making its way through the standard law creation process in Switzerland. Important thing here is that it's not a crypto law, it's not an ICO law, as in some other places was devised, but it's really meant to be more comprehensive than that. It's really focusing on blockchain as the underlying technology, which again I think is a good approach, because it recognizes the potential and the need that surrounds this theme. And there's a couple of key areas in there. And again, I don't want to become too technical, but obviously, again, principle-based regulation is all good and fine, but we obviously have our laws, and there is elements in there that were and are creating conflicts, or at least raising questions, and they're being addressed in this new body of work. So this is to do with things like the electronic registration of rights and transfer thereof, and how you have to do this. Very important, obviously, the segregation of crypto-based assets in the event of a bankruptcy. Links immediately back to some of the things I've been saying. It's about protecting investors, protecting clients, and getting this equilibrium right between innovation friendliness and protection of the market and its reputation. DLT trading facilities, very swiftly one ends up in situations of effectively doing brokerage, prime brokerage, whatever, which then triggers regulatory requirements and the need for licenses and so forth, and also services around this entire value chain, including everything from trading, clearing, settlement, and custody, with DLT based assets. So again, this is being elaborated and molded in a way to be able to accommodate for that. So to the actual classification of tokens in Switzerland, it's a trias. Switzerland looks at the option space as being payment tokens, utility tokens, and so-called asset tokens. People often talk about security tokens, obviously, but they are just one subcategory of asset tokens. And in each instance, an evaluation has to be undertaken into which category one new token falls. And from experience, having been active with my team in quite a number of those new offerings, you end up in a situation where you have a hybrid, right? This new token has various features. It may be a token for payment, but it may also be an asset token by having a dividend element in there, or by being bond-like, right? It could also be a utility function combined with a payment function, in which case you end up with a hybrid, which is entirely possible, but obviously then triggers the need to comply with a wider set of rules applicable to said classification. So if we look into them, the first one is the payment tokens, and that will be our good, beloved, classical Bitcoin, Ether, and so forth. And essentially it comes down to one thing. What is key here, and I don't think you have to be a lawyer to immediately recognize that it's about AML, anti-money laundering, right? If this is a means of payment. So this is the rules that are triggered here. There's several ways of doing that, and again, without going into the technicalities, but in order to do that, as a minimum, membership in a self-regulatory organization, a so-called SRO, for the purposes of the prevention of money laundering, is essential. You can do that yourself, you can do that as an issuer, you can do that in cooperation with specialists who provide that function, and so forth. It's noteworthy to mention that there is already technology solutions obviously available in that space, and increasingly becoming available in the space. So again, not a rocket science piece of work here, but again, if you are classified as a payment token, AML is the centerpiece from a regulatory perspective you need to focus on, and quite rightly so. Utility tokens, right? That's our good old novelty in that space, which everybody wanted to be. To be quite honest, the vast majority of clients that came to us seeking advice around that initially came by saying, we are a utility token. Sounds really good, especially if you say it real fast, because what is the consequence? You don't fall under securities regulation, and you don't trigger the AML requirements, right? So you basically don't need to do much around it. In fact, wouldn't even have to see FINMA about it. Also, it's advisable to get confirmation from them. But truth is that in most instances, when we started to take a closer look at that, we found that, well, quite often it's not a pure play utility. There was other features as well. Yeah, we're a utility, but wouldn't it be nice if we could also provide people the option of a little bit of a financial return? Well, couldn't we do a little payment on the side as well? Or is there a payment element in there? So it happened quite fast that you fall out of this space. And I always like to say it's a bit like being pregnant. You can't be a little pregnant, right? That's quite digital. And it's the same here, right? If you're not a pure play utility, then you're in a different category, and you have to be honest about it, because the worst thing that can happen is that you start in one category and later it turns out you're in a different one, and then you're in breach of the according requirements, and that's not an option. Also, it's been not explicitly stated to my knowledge so far by FINMA, but if you are to be classified as a utility token, it also means that you have to make that utility available to the members of your ecosystem within reasonable time. And within reasonable time, there's a beautiful legal term, right, which is a bit unspecific and opens the door for interpretation. And from various interactions with FINMA around that, I know that their expectation is within a couple of months, and a couple of months being more 2 than 3, certainly not 6, right? And this is again where a lot of clients struggled. Even if they had a concept for a pure play utility token, quite often it was unrealistic to realize that within such short time frame from the raise until the expectation of FINMA would have been that this utility is available, which again then quite often led to a reconsideration and an opening up to complying with stricter rules depending on whatever potential other option there is. So again, just in terms of expectation management, just saying utility token and tweaking it just to prevent rules, absolutely not advisable. And it's also the wrong mindset, as I would like to stress. Complying with the AML rules, I mean, if that is what you have to do, you have to do it, and there are solutions to support that, and there's more and more solutions coming to the table, and so forth. But you've heard that story from me before, so I'm not going to labor that point too much. Asset tokens, with all their subcategories, and there isn't a specified list or a taxonomy of subcategories. So it can be a security token, it can be a options, bond likes, whatever nature. And again, you need to look at it case by case based on the tokenomics and so forth. Now, this doesn't trigger the AML requirements, but it does trigger the need to issue a prospectus, which is sometimes that often gets overlooked. Now, talking about Switzerland, we're not talking the EU prospectus regulations, but we're talking about the Swiss requirements of a prospectus based on the Swiss law. And still, that is a significant piece of work that must be undertaken, that must be factored in, and that has liabilities that people sometimes are not too fond of, and that also includes those involved in the process of creating it. So again, just putting it out there, it shouldn't be a deal breaker if you have a valid proposition to the market to do. Creating a prospectus, again, there's many people out there who know how to do that and will be happy to support on that. But if it's what you have to do, there's no way around it, and you have to do it. So this is kind of the core concept in Switzerland. And you see variants of that around the world, right? People have 3, 4, 5 categories, sometimes elevating others which are treated as subcategories in our perspective up, or calling it security tokens, which in our case is a subcategory and so forth. But the general trias is what you by and large will find across the globe in most jurisdictions. What are other implications to conclude on that of the token classification? Again, be mindful, it doesn't end there. There is obviously other regulations that may be impacted. Collective Investment Schemes Act, right? We've seen that in particular in the context of real estate. That is, one of the most obvious cases, and a lot of people wanted to create tokenization of real estate. But to achieve efficiency, then they quite often wanted to tokenize portfolios of real estate. And in almost all instances, this then ends up looking, smelling, and behaving like a fund, which leads to the conclusion that it most likely is a fund, and hence the requirements of the Swiss Collective Investment Schemes Act, which governs the realm of funds, applies, which then means that you have to be a fund manager or involve one, and so forth. AML we talked about, so this is in the payments token space, but obviously AML and KYC quite often, which then has some implications that may be challenging in some situations, just depending on geographical spread or the way people interact, and so forth. Securities, obviously once we're in there, all the regulations apply, and we also have to be mindful that there's the Financial Markets Infrastructure Act that may come into play, which is the Swiss transposition of the European EMIR regulation. Deposits, obviously, if we end up with a qualification of deposits, this is obviously the realm of banks, and indeed the privilege of banks to accept deposits. Little sidestep, we also have fintech license now available in Switzerland with some limited optionality in this space, but by and large we're touching upon the banking world, and again need to be mindful of that and behave accordingly. And there's some other elements in there which may come into play, but I don't want to bore you. You just have to understand that you're not operating in a vacuum in nirvana, right? You are in the broader context, and you need to be aware of that and give that the proper attention.